Well, yeah, welcome to another episode of Brick by Brick presented by Parvis. My name is Stephen Glasscock. I'm a dealing representative at Parvis. Today we have a great mortgage investment company in Keystone and Ryan McNeil and Neil Andrino that are here to present. Just a quick caveat to our audience, just to make a note, today's content is for educational purposes and is not intended to provide and should not be relied upon for investment, tax, legal, or accounting advice. Nothing in this presentation should be construed as a recommendation or an offer to buy or sell any securities, such as Keystone. Now, with that said, I work at Parvis as a dealing representative. We are a technology-led real estate investment platform and exempt market dealer. At Parvis, we offer institutional quality real estate investments to eligible and accredited investors. And as I said, we are highly regulated and we aim to simplify and expedite the process for investors. Please look for us at parvisinvest.com. Look for me and any one of my colleagues across the country. So with that said, I'm going to bring on Ryan and Neil to give us a highlight and rundown of Keystone's offering.
Great. Okay. So thanks, Stephen, for having us. We're excited to be a part of another Brick by Brick episode. And yeah, to introduce myself, I'm Neil Andrino with the Keystone MIC. I'm the Director of Investor Relations. And today I'm joined with Ryan McNeil, the President of Keystone.
And Ryan, president and co-founder of Keystone MIC, and we're super excited to present the investor opportunity to you today.
So just to get started at a high level, I'm going to give you a bit of a breakdown of what Keystone MIC does, and so who we help, what we offer, and how we do it. So many are probably familiar with MICs, and so who we help is real estate investors, self-employed individuals, bridge loans, people who need money in basically a short order for a shorter period of time. And so we do that through renovation loans, quick closes, and as I mentioned earlier, bridge loans. And how we do that is we have a team in-house here, myself, Ryan, and a few other members that are very quick to respond, manage the leads, and get the money out the door and underwrite our deals. So I also, just before we get into all of our details, we're very proud of what we've been able to accomplish so far since June of 2023, so just over 2 years now. We've processed over 150 loans. It's probably closer to 160 or 170 now. We have a foreclosure rate of 0.7%, which is just one actual loan, which we can discuss in more detail later on. We've never lost an investor dollar to date, and so far we've been able to manage an annualized return of 9.4%. So today's presentation, we're going to cover 3 things. First, it's going to be the opportunity of investing in a MIC. Again, some of you may already know what a MIC is, but we're going to run through that again just to have an understanding of what that looks like and how they work. The growing marketplace that's here in Atlantic, Canada, why we think there's a great opportunity here and where we see this to going in the future. And then a little bit about our team and some deals that we have done, just to give you an understanding of what that looks like. So first, I'm just going to hop into the opportunity that the MIC provides and how it's kind of an attractive way to make some passive income. So first, just looking at what is a MIC. So right in the middle there, you have the MIC structure. That's a mortgage investment corporation. On the left would be yourself, an investor. And so you would invest your capital into the MIC. The MIC is a pool of funds. From that pool of funds, then we administer lending it out as mortgages. So on the right-hand side there, you see mortgage funding going out, and that gets secured against real estate assets. Those borrowers then make payments from the money that they borrowed. That goes back to the MIC, and then finally that gets distributed to you as dividends, as interest dividends back into your account. When a property is sold, they pay back that entire loan to the MIC, and that money goes back into the pool and then is re-lent out. So some of the really compelling investor benefits associated with the MIC is obviously risk diversification. So some of you are maybe familiar with the fact that you can do independent loans and you can loan to one borrower on one property. This gives you the opportunity to spread that investment across hundreds of deals and multiple properties. The investment is still secured, so they're all mortgages that are secured against real estate assets. It also allows for a much more predictable income stream, because if 1 or 2 payments are missed, there's still enough of a buffer that you'll get a consistent standardized payment every single month. Additionally, by being in MIC, there's some opportunity to utilize some of your registered accounts like an RRSP, an RESP, TFSA, your RIF. It just gives you some options to save on the tax dollars. And then finally, the other thing is that's really nice is there's a drip option. So if you say, hey, you know what, I don't really want the income or need the income right now, you can leave it on drip, and that can really boost your overall annualized return. So here's a chart that we like to show just simply because it gives you kind of an idea of the different opportunities available in the real estate industry. On the far left, we have direct private lending, and then all the way on the right, we have the mix. And in between that, we have real rental property investment, which again, I'm sure many of you are familiar with or have engaged in the past, and then REITs, which is obviously your publicly traded real estate investment trusts. And so really the main thing to take from this is that getting involved directly, whether you're owning the real estate or doing the lending yourself, there's a lot of work. There's also a lot of risk associated with that. And with that, you also do get a higher rate of return. As you go over to the right side of the screen, you see things like REITs and mix, and that allows you to get some diversified options with a lot less management. It's completely hands-off as there's a manager involved, but you do take a slightly lower rate of return for doing so. But again, it's a completely passive investment and helps to reduce your risk exposure. So now I'm going to pass it over to Ryan just to discuss the growing market that we have here in Atlantic and why we're really excited about it.
Yeah, thank you, Neil. So as Neil mentioned, we gave you the quick overview of what a mortgage investment corporation is, and now we're going to talk about why Atlantic Canada is a compelling opportunity and a growing opportunity in Canada. So you can see on the left side of this chart here, the average home price in Canada is about $670,000, obviously substantially higher in Ontario and BC as well. But in the right column there, you can see that Atlantic prices are substantially cheaper and actually on average are 44% cheaper than the average Canadian house. So obviously more affordability in the Atlantic market and likely more potential for potential upside in the long run. And a recent survey by Zoocasa as well showed the best places to buy real estate in Canada in 2025. Atlantic Canada had 4 of the top 6, and including 3 of the top 4 cities to invest in Canada as well for this year. And a couple other reasons in general why the MIC opportunity is compelling. So the Canadian mortgage space is going more private. So we estimate the size of the private market to be $33 billion in Canada, which represents about 1.4% of the market. And the outlook is very positive as well due to multiple reasons. And of course, you've probably heard, tightening government regulations with the B20 and the stress test back in 2018, 2019. And of course, there's been a substantial increase in self-employment, which tends to be more difficult for these borrowers to qualify for traditional financing and often increases the need for alternative financing. And the MIC space in general has grown as well. So back in 2018, there was about 200 MICs in Canada. That's grown to over 300 MICs in Canada. So an over 50% increase in the past couple of years. And so the growth of Atlantic Canada means, of course, private lending is on the rise out here as well. So based on our population proportion in Atlantic Canada of 6.5% of the Canadian population, we estimate the private market is about 640 million. So if we're to estimate very conservatively, Keystone attaining a 5% share of the private market in Atlantic Canada, that's about a $30 million opportunity for us in 2025. Yet while this opportunity is very big, the majority of MICs in Canada are not lending in Atlantic Canada. So most of the major MICs across the country, of course, are focused in Ontario, the major centers. About 49% of MICs are lending there, where 36% are lending in BC. Smaller proportions in Alberta and Quebec, but the Atlantic market only represents about 2% of private lending in Canada, versus what I mentioned before about our population representing about 6.5%. So there's a substantial opportunity there for runway and future growth in the MIC space in Atlantic Canada. I'll hand it back to Neil here.
Thanks, Ryan. So yeah, now I'm just going to go through our team, and then Ryan will go over a couple deals that we've been involved in the past. So obviously you've met myself. I'm the Director of Investor Relations. I have a background in real estate. I was originally an investor that actually then jumped into the private lending space after having utilized a lot of private lending myself. Ryan, as he's discussing now, he has been in the industry for over, 10 years now, Ryan?
Almost 10 years, yeah.
He's been involved in over 1,700 mortgages across Atlantic Canada. So he has lent on every nook and cranny of the Atlantic provinces, uh, lent out over $350 million in private mortgages. So very experienced, if not the most experienced person here in the Atlantic region. And then our Director of Credit and Risk, Zach Muir, he manages the underwriting procedures for us. He also has been involved for over 15 years in the industry, previously also being a mortgage broker, which has been really valuable for us because he truly understands the exit strategies required to get out of these deals. So Ryan's going to run through a little bit of our underwriting process and then show you guys an example deal.
Absolutely. So as Neil mentioned, Zach is our primary underwriter, director of credit and risk here in Atlantic Canada. I'll just kind of walk you through a process of how we evaluate a loan and how we ensure we're preserving that investor capital. So our most important piece, very different than how a bank would underwrite a transaction, but we put a ton of value on location and exit strategy. We really are focused on short-term lending, 6 to 12 months, 12 months at the absolute maximum, and we're really trying to cycle through these transactions as much as possible. And we really shy away from that transaction where, some people associate private lending with, maybe damaged credit or past bankruptcies. We don't really lend in that space. We're much more focused on someone who's got irregular income, maybe they're self-employed, and we take that all into consideration. And as long as the borrower can service those loan payments over the period of time, and there's a strong exit strategy on the back end, that tends to be a good borrower for Keystone. We also put weight on property quality, their income, and their credit as well as part of our scoring criteria. And I'll walk you through just a recent example we did here. And I love this type of scenario for the use of private funds as well. This particular couple, retired couple, so had somewhat limited income coming in on their pensions. But the property itself was in a great area of Halifax, our primary lending area, slightly dated, but still very much move-in ready. And what they were doing was they're actually selling their existing property, which had a very small mortgage on it, and then closing on this new property. The challenge was they had to actually close on the new property before they were even able to list their existing property. So rather than, having to cash out investments or, borrow against something else to make that down payment, what we did is we actually leveraged both properties. So we secured their existing property, and then we of course were first position on the purchase property as well. And then within a couple months, they were able to list and sell that property. It obviously scored very well on our scorecard here as well. I think it would ended up being a 2-month term total for this deal. So we actually generated a very strong return. I think it was about an 18% return on this transaction. I mean, not all of our loans end up being 18% return, but this kind of gives you a good indication of kind of the wheelhouse we're playing in.
So in summary, the Keystone MIC, we've designed it to deliver really strong yield and outperform a lot of the marketplace, and to provide a great exposure to a diversified marketplace here in Atlantic Canada. So again, strong targeted returns. We're looking at 9 to 9.5%, depending on which class share you're involved in. The portfolio is diversified across 4 provinces, multiple types of real estate. You can utilize registered plans to save on taxes, whether it's RRSPs, TFSAs, and then finally, again, market exposure. So it's a pooled capital model. Your money is not tied to one singular property or one singular borrower. You're getting the opportunity to have the exposure across a lot to help reduce your risk.
That's great. I think there's certain markets like you guys mentioned, British Columbia as an example, where you can't throw a stick and without hitting a mic. I think that's critical that the growth at Atlantic Canada, me being in Atlantic Canada myself, that you guys are poised to capitalize on that, one of those angles. So I have a couple questions maybe on a few things that I know some people have brought up. For example, other mix that I've spoken to have kind of talked on default, like when a default hits, like if you could walk through, I know you mentioned kind of 1 and the 0.7 overall. What's that, what's that like? Because I know some mix will say like it used to be 6 months. If 2 missed payments, we trigger, and then it can be up to 12 plus months. So I'm just curious on defaults.
Yeah. So, I mean, of course we underwrite all of our transactions to avoid this at all costs. it does create a heavy admin burden when you do have to go through that process. I've been through it in the past, but again, we also underwrite to protect ourselves in that scenario, that if there was ever the worst case scenario of a borrower defaulting, that you're well protected and you preserve that investor capital. But the process, so that's the interesting part, Steve, is that we lend in 4 different provinces. We lend in Nova Scotia, New Brunswick, PEI, and Newfoundland. So there's all different enforcement legalities within those 4 different provinces, right? So we're very fortunate to have strong legal assistance in all 4 provinces. So it very much varies, to answer your question, in terms of like the timeline there. I'd say we are more so around the 2 months of missed payments. That's when we would start, the demand letter aspect. But we're always proactive with borrowers, even if they miss a payment and it's the day after. We're proactively communicating with them to ensure that that payment's caught up. And if it can't get caught up right away, let's implement a payment plan to ensure you get caught up, right? So it's very much case by case in that space, but we do our best to stay on top of it. And it's only in the worst case scenario that we'd actually go through and enforce if the client's not communicating back with us.
Great. No, maybe another question that's come up, in general, how about the oversight? Like, how is it you're structured for sort of the oversight? It's very, you guys mentioned it's very much regulated. Just curious, in Keystone sort of aspect, the oversight of the company.
Yeah, it's another thing that's complex with lending in 4 different provinces, but we're licensed across the board, both as a lender and administrator in all 4 provinces. So our primary province is Nova Scotia. It's the Mortgage Regulations Act that came into effect in 2021. So we're licensed as a lender and an administrator under that act. And of course, in New Brunswick, it's FCNB, which same thing, licensed as a lender and administrator in New Brunswick. And then, of course, as a MIC, same as all MICs are in Canada, regulated by the Income Tax Act, which is a national body that we abide by.
On a board level, how about that side of it?
A board level, like internally for us?
Yeah, internally.
Yeah, so we, myself, Neil, and our business partner Zach, make up the Keystone's board at this point. We've had discussions on how that'll look in the future, but once we reach a certain size, we may look to have an external board as well.
And what would an average mortgage is it in the 150 to 250 kind of range?
A little bit higher than that. It's about 275 would be our average loan size now. We prefer to be focused. I know Neil's going to get to this as well, but we prefer to focus on the first position mortgages. Our portfolio is, I think, 85 or 87% first mortgages right now. And just given the average price points in Atlantic Canada tends to be more in the 275, 300 range on the average loan.
With an LTV that kind of looks like on average.
LTV, obviously, lower the better for us, but our portfolio LTV is sitting around 57 or 58% right now across about 90 loans.
That's amazing.
Yeah,
I just think, yeah.
Sorry, go ahead.
No, so I think it's great. Yeah, that's a great number. Just saying.
Yeah, that's something I think actually it's funny now as we're going through this. I'm like, it would be good for us to mention a little bit sooner. But something again that we're also very proud of is because of the opportunity available here in Atlantic, we're able to keep a really large position of first position mortgages as well as a lower loan to value. Like Ryan said, it's around 84% first position mortgages and then a loan to value of 57%. So you're very well secured and in a position to be able to reclaim the asset if it's required.
It's huge. Yeah. Oh,
And
that's,
I'll just add on to Neil's point there as well that despite the fact that we primarily focus on those lower risk first mortgages at lower LTVs, we still do return. Our targeted return is substantially higher than you'd find with MICs in other areas of the country as well.
I think it's a great investment. There's it's a very steady, great investment for the RIFs, for the RSPs, for the registered accounts for sure. Obviously, you mentioned the drip. Obviously, people can also kind of maybe go 50-50 on a half cash, half buying shares. Correct?
Exactly. Yeah, that's a great option for people.
Excellent. Well, I appreciate you guys taking the time today. I don't know any last points, but much appreciate your guys' time.
For sure, Stephen. Yeah, I'll just make a couple last points just for anyone who's considering an investment, just to quickly go over our two share classes, and then additionally what we have out right now. But so as you see on the screen here, we have a Class A and a Class B share, and really the main difference is the investment size. So looking first at Class B, that shows our minimum investment, which is $25,000 to get involved, and we target a 9% annual return on that. Again, that is net of fees, and that is 9% annualized, so it's paid every single month on the 15th of the month. If you're able to have a larger investment of $250,000 or more, that targeted return goes up to 9.5%. And now both of those can be left on DRIP, so dividend reinvestment. And when you do that, a Class B is around 9.4%, and a Class A is around 9.9%. So a fairly strong return on those shares. Yeah. And then just finally right now, I mean, this will only maintain relevant for so long, but you will also see on the Parvis site what we're doing in that current funding round. So at the time of recording this, we're in the process of fundraising around $10 million. Not around, we are fundraising $10 million. We're about $6 million that funded. And with everything in the pipeline, we're hoping to be around 8 million. So there's a little bit of room left in this current fundraising round, and we hope that we can get you guys to reach out and get involved in the future ones.
Absolutely. Yes. Please visit again parvisinvest.com and look for Keystone MIC on our site, and then reach out to myself or any one of our dealing reps for more information.
Thanks,
Thanks,
Stephen.
Sheldon.
Thank
All
you.
right. Well, enjoy the rest of the day.
Thanks, everyone.
Take care.